Yeah, thank you. And also, talking about silver, which we've seen have quite a rise as well. It doesn't quite have that central bank push, or at least not yet. But we have seen a tremendous appreciation, and right now a major uptrend developing in silver. How do you view that going
Well,
forward?
you're right. And silver is a little more difficult to analyze because it is a precious metal. So it has many of the same characteristics as gold, but it's also an industrial input in electronics and automobiles and other industrial applications. So it's sort of it can be pushed and pulled at the same time. Certainly, the precious metals vector is taking the price higher, but we're looking at an industrial slowdown around the world. Germany, Japan. Japan's in a technical recession. Germany's they're committing economic suicide. I don't know. It was used to be the greatest industrial machine in the world. The German engineering is sort of second to none, and that place is falling apart. And the reason it's not hard to figure out is energy costs. I bought a German car last year, an Audi, and I like Audis. I've been driving them for decades. But I'm very particular about the specifications. And I read it when I took delivery. It's a German car, but the engine was made in Hungary. And like,
Sure.
well, that's interesting. Why is the biggest auto manufacturer in Germany outsourcing the engines to Hungary? And the answer is the energy costs are lower because Hungary continues to buy oil and natural gas from Russia, and Germany has fallen for the Green New Scam. So yeah, energy costs are labor costs and capital costs all matter, but energy costs are one of your biggest inputs. And I'm fine with Hungary. They're smart. They're hardworking. The kind of way the Germans used to be.
Yeah.
But so we have this industrial slowdown all over the world. There could be a little bit of a headwind for silver. Having said that, the precious metal vector is dominating at the moment. Silver follows gold. There's no way that gold's going to $10,000 an ounce, and silver is not going to $100 an ounce. It will, but it tends to lag a little bit. But gold has been performing so well for several years at this point that the lag is over, and now silver is starting to catch up. And often, when silver is later to move, but when it does move, it can move even faster. So I don't think circling $50 an ounce, I don't think is even a little bit of a stretch. Sure. You're absolutely right that a lot has changed. Gold was it was teasing 3,900. I think it was over 3,900 briefly. It's kind of 38, 90. But it'll go past 3,900. It's on its way to 4,000. That won't take that long. But we said that at the Rule Conference that was in early July, as I recall, so a couple months ago. And you're right, gold wasn't where it is today, but we said it's going that way. And the important thing I think for viewers is to understand why. In other words, we know the what, it's going up. Okay. But then there are obvious questions from that. Number one, if you go all the way back to when it was 1700 or 1300 for that matter, it's tripled from there. People can say, well, have I missed the boat? Is the too wish I'd bought it at 1300, but did I miss the boat? Is the rally over? Question number one. Number two, what's driving it? Will that continue? Kind of a variation on the same question. The answer is no, you have not missed the boat. You missed $2,600, but this is really just getting started. It has a lot further to go. So if you have gold, if I recommend 10% investable assets. You might want to top up a little bit, but if you don't have gold, it's not too late to get some into your portfolio. Number one. Number two, the question, will it continue and why? The answer is yes, and here's why. Number one, central banks are net buyers and they're continuing in their buying. That is not going away. The inflection point was 2010. It's easy to look back from 1970 to 2010. Central banks were net sellers. Since 2010, they've been net buyers, but the net buying has increased. Now, it's not the same central banks. The sellers were UK, Australia, Canada. The US actually sold quite a bit of gold in the 1970s, stopped cold in 1980. Interesting, the US has not sold any gold, any
Hmm.
official gold, since 1980. There are reasons for that are deeply buried in Fed history. We don't have time to go into them, but I think we can count on the fact that the U.S. will not be selling any gold. Switzerland did it for a while. They had an uproar in the referendum. They stopped. So the sellers have stopped, but the buyers have come in. And basically, we have new buyers. We have yeah, Russia, China. When I say new, Russia has quadrupled its gold reserves since 2009, from 600 metric tons to over 2,500 metric tons. China, same thing. They've gone from 600 tons to over 2,500 metric tons. Officially, there's very good reason to believe that China has actually a lot more gold than that, but we'll leave that to future revelations. But even what they admit to, they've quadrupled their gold reserves. So it's not an overnight phenomenon. But the point is, it's continued, and other central banks have jumped in. If you look around, I mean, all this data is available from the World Gold Council. But Vietnam, Kazakhstan, Turkey, we know Iran is a major buyer. Iran is non-transparent, but that's okay. They're still out there buying, and other countries around the world have joined in. Even Japan increase their gold reserves from 600 to 900 metric tons. So now this by itself does not mean that gold goes to gold. This is not something that will cause a spike. But what it does, and this I think is interesting for investors, it kind of puts a floor under the price. Central banks are very savvy buyers. They're not going to chase a frenzy. They do, I hate to use cliches, but they do buy the dips. What they really do is they put in standing orders, 10 tons a month, 5 tons a month. They put in the orders with the London dealers. They don't want to disrupt the market. They're all out to buy more. If you were buying more gold, you wouldn't want the price to skyrocket because you'd have to pay more. So, but the point is, this kind of steady, slow and steady approach puts a floor under the price. So if you're an investor, either you own it or you're a new investor, this is what I call an asymmetric trade. No guarantees, of course, but you have very limited downside because the central banks are buyers, but you have unlimited upside because this is just getting started. So that's one factor. Second factor, good old fashioned supply and demand. We learned this our first week in economics class in college or high school, depending on where you went. So supply has been very constant. New mining output, it's around 4,000 metric tons a year, up a little, down a little, but has not changed much in 6 years. You look at that chart; it's pretty flat. Just the variance is very, very small. So output's steady. Demand is going up, as we just explained, because of the central bank. So when supply is constant and demand is going up, guess what happens? The price goes up. It's just, like I say, economics 101. Um, the third factor is, and this is now we'll dip into behavioral psychology a little bit, but there's I think it's a valuable tool, part of the toolkit. There's something called anchoring. It's a cognitive bias, but we get anchored on we get things, and then we don't really. Becomes a filter about how we think about things. So people get anchored on price with regard to gold, and you should. I mean, no reason not to. But let's just say you have 50 ounces. I'll just make up a number, and it goes up $1,000 an ounce. Well, you just made $50,000. And if it goes up another $1,000 an ounce, you made another $50,000. So you're sort of telling yourself, hey, good deal. Every time it goes up $1,000 an ounce, I make another $50,000. But what people don't realize right away, I mean, the math is simple, but they kind of don't think about it this way. Each one of those $1,000 hurdles that I just described is easier than the one before. So when you go from $2,000 to $3,000 an ounce, that's a 50% increase. That's a heavy lift. When you go from 3 to 4, that's a 33% increase. Well, when you go from 9,000 to 10,000, that's only an 11% increase, which is like a good month, lately. My point is, as you go from 6, 7, 8, 9, 10, people go, oh my goodness, we'll never get to $10,000, but actually you'll get there faster than you think because those successive $1,000 bumps are each one's easier because you're working off a higher base. It's the denominator is bigger. This is fifth grade math, but psychologically, people tend not to think of it that way until they turn around and go, oh yeah. So when you talk about even $20,000 gold, it sounds like a fairy tale land or something. But when you go from $19,000 to $20,000 an ounce, it's a 5% increase. Like you say, the gold's going up 1 or 2% a day. It's not a heavy lift. And so that's what I call the frenzy stage. Now, when we get there, and we will get there, when we get there, that's when you have to be careful and say, well, okay, is this sustainable? Is this a time to sell? Maybe I'm not saying it is. Who knows how high it can go? But it's where you do have to be a little more alert to what I call the frenzy dynamics. But my point today, Naomi, for our viewers and your followers, is we're not there yet. We will get there, but my point is we'll get there faster than people realize. And so this is still a very good time to buy gold. And final reason is, people say, well, gold's an inflation hedge, and there's not too much inflation, a little bit, but not really too much by historic standards. And the answer there is gold's an okay inflation hedge. The correlation between inflation and gold prices is less strong than people realize. Gold went up 75% during the greatest sustained period of deflation in U.S. history, which was the Great Depression. From 1929 to 1933, we didn't have low inflation or disinflation. We had deflation, and it was powerful. And gold went up 75% from $20 an ounce to $35 an ounce. The best performing stock on the New York Stock Exchange in the Great Depression was Homestake Mining, which was a gold mine. That was the basis of the Hearst family fortune. So gold does very well in deflation and inflation. And so when you think about it that way, gold is what I call the everything hedge. It hedges uncertainty. It hedges, inflation, deflation, social unrest, riots, wars, geopolitical stress, natural disasters. It's good for everything. And I run into people and they say, "Well, Jim, you have gold in your portfolio. How do you sleep at night?" And I say, you're 90% in the stock market. How do you sleep at night?" So, so I think there's a long list of fundamental reasons. Again, central bank buying, flat output, the everything hedge, and just the math of increases get easier as you go along. That all suggests that gold is going to go much higher.
Yeah, no, thank you for laying that out so clearly as you always do. And it is interesting, just to touch on the behavioral aspect of that, and the people that do think that they've missed the boat on gold. But when you look at all of these factors, none of which are going away, nobody has missed that. And I think that you lay that out very, very clearly. And you have talked about having potentially up to 10% gold in portfolios for a time, and now you're talking about potentially bumping that up.
Yeah, or if you don't have 10%, then get yourself to 10%. If beyond that, it's season to taste. I know people who are 50% in gold. They go, "Well, that's a little high," but you don't want to be all in any asset. It doesn't matter how attractive it is. That's just good, diversification, good portfolio management. But as I say, season to taste. But if you don't have any, get some, and if you're not up to 10%, it's still a good time to top up. Right. Let's just separate the debt side and the Fed side. On the Fed, they're going to keep cutting rates. They'll do their standard 25 basis points. But if there are a lot of indications that the unemployment rate is about to go up a lot. We've seen it in ADP. We've seen it in JOLTS. We may not get an employment report because the government shut down. We'll see. But it's the unemployment rate is not skyrocketing. It's not high by historic standards, but new hiring has hit a wall. Well, if there's no new hiring, even normal attrition, layoffs are going to take the unemployment rate up. So the Fed's going to keep cutting rates, and it's a little early. I think the next meeting is in I want to say late October, very end of October. I'll give a forecast a little closer to the date, but for now, I would say 25 basis points, but don't rule out 50, depending on what turns up in the unemployment data in the meantime. But here's the point: and part of the reason it's economic and also political. The Trump has two appointees, Bowman and Waller, who already voted ahead of Jay Powell. They dissented in I believe the August meeting. Now we got Stephen Moran, who's a hardcore Trump supporter. So you got three seats. And the last thing Jay Powell wants are any, like 8-4 votes. The four 8 wins over 4, but you get 4 dissents. You've lost your mojo as chairman of the Federal Reserve. So they want to keep it, 10, 11-1, 9-3, whatever at worst. So if you've got 4 votes to cut rates, Powell's not going to fight that fight. They're going to cut rates. Having said that, it's really important for investors to understand that it's not going to do any good. The Fed is behind the curve. They're not leading the market. They're following the market. When you look at by the way, when you say the Fed cuts rates, what are they cutting? They're cutting the federal funds target rate. That's what they do. That's called the policy rate. There hasn't been a federal funds market since 2008. Federal funds are excess reserves that banks lend to each other on an overnight unsecured basis to meet reserve requirements. Well, the Fed printed $10 trillion of excess reserves that are all undeposited at the Fed. So banks don't need reserves because they got $10 trillion sitting on deposit at the Fed, as I said. And so the Fed's targeting a rate for a market that hasn't existed in 17 years. That's the first thing people don't get. But there are actual markets that come close to that target rate, which are the 4-week Treasury bill. That's like one of the short. The Fed can issue 1-week bills if they want, but a 4-week Treasury bill is the most liquid, safest instrument the Treasury issues. So that's equivalent to a short-term rate. There's also something called the secured overnight financing rate, which is roughly equivalent to the repo rate, which is secured. Both of those rates, which are real honest to goodness short-term rates in liquid markets, are lower than the Fed funds target. So the Fed's not leading anything. They're tagging along with the market, number one. They're too late to the party, number two. But here's the bigger point. It's not going to do any good. The idea that low rates are stimulus is nonsense. There's no support for that. No research or economic support. Low rates are associated with recessions and depressions. And so, my message to the White House is, Donald Trump's banging the table, cut the rates, cut the rates, cut the rates. They are going to cut the rates, but it's not going to do any good because we're heading into a recession. So it's like, be careful what you wish for. In a healthy economy, interest rates should be 4 or 5%, maybe even a little bit higher, not because of inflation, but because of demand for funds, banks' willingness to lend, banks want to make money, borrowers want to borrow because they think they can make more. That's what a healthy economy looks like, not 1% rates. So the Fed's going to cut. It won't matter because they're behind the curve. Rates are going lower. That's clear, but they're going lower for a very bad reason, which is we're heading into a recession.